you're probably making emotional decisions with your money and you don't even realize it. Every financial crisis feels like the end of the world, and that's exactly why most people lose money during them. Not because of bad investments, but because of bad reactions. When markets crash, people panic. They sell low, wait too long to buy back in, and miss the recovery. It's a predictable pattern, but it doesn't have to be yours. The truth is, crises are when some of the best investment opportunities are born. But taking advantage of them requires one critical skill: emotional discipline. Let's take a step back. In 2008, when Lehman Brothers collapsed and global markets went into freefall, investors were terrified. Many pulled their money out at the bottom, but some stayed in, or even doubled down. One of them was Warren Buffett. While others were running for the exits, Buffett famously wrote an op-ed in the New York Times titled, "Buy American, I Am." He was buying stocks in companies he believed would survive and thrive. And of course, they did. The S&P 500 went on to triple over the next decade. What Buffett understood is this: crises are temporary, but your investment behavior can have permanent consequences. Let's bring it to today. Whether it's inflation, geopolitical tension, or a banking scare, there will always be something that shakes the markets. But the best investors have a system. They don't rely on emotions or headlines. So how do you build that kind of resilience? It starts with understanding your own psychology. Studies in behavioral finance show that loss aversion, our fear of losing money, makes us twice as sensitive to losses as we are to gains. This leads to irrational decisions like selling an asset just because it dropped 20% even if nothing fundamental has changed. That's why in a crisis, the first rule isn't what to buy, it's how to think. Let's say you own a diversified ETF and it drops 15% during a market panic. If your instinct is to sell, stop. Ask yourself, has the actual value of the companies inside that ETF changed? Or are they just being repriced because of fear? 9 times out of 10, the fundamentals are still intact. But your brain is wired to react to the price, not the value. That's where the greatest danger lies. Because when you sell out of fear, you not only lock in losses, you also miss the inevitable recovery. The data is brutal. Missing just the 10 best days in the market over 20 years can cut your returns in half. So if your goal is long-term wealth, surviving the storm is more important than predicting when it will pass. In the next section, we'll look at exactly what you should do during a crisis to position yourself for massive upside, without losing sleep or your sanity. Let's get tactical. Once you've trained your mind to stay calm during a financial storm, the next step is to act with intention, not impulse. The first thing to remember is this: cash is not trash during a crisis, it's optionality. Having liquidity when others don't gives you power. It allows you to buy quality assets at a discount, assets that others are dumping out of fear. Take March 2020. When COVID hit global markets, the S&P 500 fell over 30% in just weeks. Investors were liquidating everything: stocks, bonds, even gold at one point. But those with cash on hand were able to scoop up shares of companies like Amazon, Microsoft, and Apple at massive discounts. By August, many of those positions were already back in the green. Within a year, they had doubled. This is what smart investors do. They don't run from the fire, they look for what's not actually burning. Start by building a watch list of companies, ETFs, or assets you understand well. When a crisis hits, you won't be scrambling to figure out what to buy. You'll be ready to strike. But here's the key: don't try to catch the exact bottom. The legendary investor Peter Lynch once said, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves." The better move? Dollar cost averaging. Instead of dumping all your money in at once, spread it over time. If the market keeps falling, you buy at lower prices. If it recovers, at least you're already in. It's a strategy that smooths out the highs and lows, and it works. Let's say you're sitting on $10,000 during a market downturn. Instead of investing it all today, you could invest $2,000 a month for 5 months. This approach protects you from short-term volatility, but keeps you in the game. And don't overlook dividends. In times of uncertainty, companies that consistently pay dividends often outperform. They provide cash flow even when your portfolio is down. Think of it as getting paid to wait. In the 2008 crash, companies like Johnson & Johnson and Procter & Gamble continued to pay and even raise their dividends. Those who held onto these stocks weren't just surviving, they were collecting checks the whole time. Another tool, rebalancing. When the market crashes, your asset allocation shifts. For example, if stocks fall 30% but bonds remain stable, suddenly your portfolio is more bond-heavy than intended. Rebalancing forces you to sell what's expensive and buy what's cheap, automatically buying low and selling high. And if you're investing through a retirement account or tax-advantaged vehicle, that rebalancing can happen without triggering capital gains taxes. It's a simple strategy, but incredibly powerful. Lastly, avoid the media noise. During crises, headlines are engineered to trigger fear. Markets plummet. Recession fears. Biggest drop since 2008. It's designed to make you act. But the best investors don't react to headlines, they follow their plan. Your job isn't to outsmart the market, it's to outlast the panic. In the final section, we'll break down how to prepare before the next crisis hits. So you don't just survive it, you come out stronger than ever. Preparation is your best investment. If you wait until a crisis hits to make a plan, you're already too late. The key is to prepare during the calm so that when the storm comes, you already know exactly what to do, and more importantly, what not to do. That starts with building an all-weather portfolio, one that doesn't rely on predicting what comes next. This means diversifying across asset classes, stocks, bonds, real estate, maybe even a small allocation to gold or commodities. Each behaves differently in different economic conditions. Ray Dalio, founder of Bridgewater Associates, is famous for this principle. He created a portfolio designed to survive any market environment by balancing growth with protection. Not by guessing the future, but by preparing for multiple outcomes. The second part of your defense is psychological resilience. Set rules in advance. Decide, for example, that you will never sell an index fund unless your financial goals change, not because of fear or media hype. Commit to rebalancing once a year. Build automatic contributions that continue regardless of market conditions. This removes the emotion from the equation. You should also have a crisis checklist. When markets drop sharply, pull it out. It could say things like, do not panic sell. Check emergency fund. Do I need this money in the next 12 months? Revisit watchlist. Any great companies at discounts? Continue DCA as planned. These aren't just financial tools, they're mental anchors. Because here's the truth. Every major crisis has looked different on the surface, but underneath, the pattern is the same. Panic, drop, recovery, growth. Over time, markets have always bounced back. The Great Depression, Black Monday, dot-com crash 2008, COVID. Every single time people thought it was different. Every time those who stayed invested ended up ahead. So when the next crisis comes, and it will, you'll know better. You'll recognize the fear for what it is, a temporary cloud over long-term opportunity. You don't need to be the smartest, you just need to be the most consistent. And if you follow that path, you'll find that crises aren't just something to survive. They're the very moments that build real wealth. So, if this video helped you shift your perspective and prepare smarter, hit that like button and subscribe for more content like this. Comment below, what's your strategy when markets crash? Let's learn from each other. And remember, the sooner you build your plan, the stronger you'll be when the storm hits.